All right. Today is Monday, February 6th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. But before we start, my condolences to the victims of the earthquake in Turkey and Syria. Tragic news, and my heart goes out to all of the victims. Now, let's talk about the market because so far, year to date, we have a massive rally in the equities market. We have a massive debate too. Some argue that this is the end of the bear market and the beginning of a new bull market. And others, of course, argue that this is yet another bear market rally. It's a trap. It is a rally based on technicals and mechanical reasons, and it's going to fade away. And as the debate rages on which side will end up being right or wrong, what we can do for now is look at certain trends, but most importantly, certain psychological indicators, if you may. For example, the rally has been going on year to date unstoppable, regardless of any bad news. But you got to be careful with the interpretation here because some would argue that bad economic news actually equals good news for the stock market because it moves the Fed toward the end of the tightening cycle of the monetary policy. And this is exactly what the market is looking for. The market is looking for the Fed to step out of the way. The Fed cannot step out of the way until inflation starts to go down in a sustainable fashion. Now, we got a few readings of inflation cooling down, and of course, that fueled speculation by the market that the Fed will step back from the tightening of the monetary policy, and therefore the buying happened before the news. And of course, there was a lot of fear that when the news actually takes place, meaning the FOMC conference, we will see Chairman Jerome Powell pouring cold water on the market's assumptions and ending the rally, perhaps by suggesting that there is more work to be done. But of course, the chairman of the Fed made a mess out of himself, and he declared victory against inflation prematurely, meaning confirming what the market has been saying all along. And of course, the market took this as a green light to continue the rally, and the higher the rally went, the more speculative, the more impulsive, the more risky it became. What started as perhaps short covering of certain losers from last year, combined with some dip buying in big cap technology stocks, now became a full-blown meme stock mania frenzy, the likes that we've seen back in 2021. And we all know how that movie ended. But rest assured, when it comes to the retail investing and trading community, no lessons learned at all. Take, for example, what happened today with Bed Bath & Beyond stock. Amid the rumors that the company is about to declare bankruptcy and default on its loans, the retail mom and pops thought it was a great opportunity to buy the stock and stampede and create a gamma/short squeeze. And on the rumors of bankruptcy, the stock surged higher, almost doubled in price today, scoring gains north of 90%. And of course, I warned and I said what the geniuses, quote unquote, who are chasing bankrupt company don't understand is that it is just a matter of time before these companies use pumps to dump stock and raise much needed cash. The problem with this monkey rally, and I call it the monkey rally because it's all based on monkey see, monkey do. It is not based on fundamentals, not even based on the reality of the macro environment or the reality of inflation. More on that in a minute, but immediately after the bell, we got the news that Bed Bath & Beyond is planning to do exactly what I warned will happen. They're now offering more shares to raise much needed cash to avoid bankruptcy. Thank you to the monkey rally and the monkey money, now Bed Bath & Beyond might actually be saved from bankruptcy. And of course, in reaction to this news, Bed Bath & Beyond is down about 40% after hours at the time of the recording of this video. And the sad outcome of all of this is some retail mom and pop bet $50,000, $60,000 money they cannot afford to lose, chasing the pop in Bed Bath & Beyond, and now they're down 40%. Today in Discord I said, I'm still seeing huge appetite in buying call options and betting on the market rally to continue, especially in the year-to-date winners. It seems that the speculative sentiment has been shaken, but not completely washed out. Powell speaks tomorrow. Now, what does that mean? It means that in this speculative mania of a rally that we got so far, we got a warning shot on Friday, which negates the assumption that inflation is dead and the Fed is about to ease, and therefore we have the green light to buy equities and stampede on risk on. And the warning shot we got on Friday is the extra hot jobs/employment report, which, if you believe it to begin with, indicates that the underlying conditions for inflation are not defeated yet, and there is a high probability that we will see a rebound in inflation very soon. Now, what happened today in Bed Bath & Beyond with the sour taste in the mouth of a lot of retail mom and pops investors and traders who chased the move could be considered as warning shot number 2, that if you stampede and you chase these almost most bankrupt companies, they're going to use the opportunity to dilute the value of the stock because they know that there is no soft landing for them. And if indeed inflation rebounds, it will mean that the Fed will need to raise interest rates even higher than previously anticipated, which will guarantee the bankruptcy of these companies. So they have to raise cash at any opportunity possible. That's warning shot number 2. Warning shot number 3, perhaps what could seal the deal, the fate of this monkey rally, is the upcoming speech by Chairman Jerome Powell, the imbecile that he is. And if he decides to backtrack the mess that he made last Wednesday, then the market's assumption year to date, which is, inflation is going down, the Fed will pivot and end interest rate hikes and perhaps move to cuts. That thesis, that entire argument, the entire foundation of the year to date rally, aka the monkey rally, will be demolished. Today we got commentary from Atlanta Fed President / insider trader Raphael Boystick, who suggested that due to the strong quote-unquote jobs report that we got last Friday, the Fed might need to increase interest rates to a higher peak than policymakers had previously expected. Surprise, surprise. Who has been saying this all along? Yep, the guy you're listening to right now. But folks, aside from the technical reasons that could end this rally, which is the overbought, overextended conditions on the charts, or the fundamental reasons that we just talked about regarding the rebound of inflation and the false assumption, even by the Fed itself, that it needs to slow down interest rate hikes or perhaps pause them altogether. Beside all of that, what are the mechanical reasons behind a reversal of any rally, but specifically a bear market rally? If this is indeed a bear market rally and not a legitimate start of a new bull market. We talked about this in last night's video, so I'm not going to go in details here. Just want to give you a background and then we move on to the indicators and you tell me what you see. The stages of a bear market rally starts by short covering. Those shorts, while they cover, they also buy call options. The sudden surge in call options buying and the covering of these stocks, which is pretty much buying the underlying stock, gives feedback to the market maker who's writing these call options to also start hedging by buying the underlying stock. So now we got two forces buying whatever stock it is. You got the shorts covering and you got the market maker also hedging because they see the surge in buying call options. That is called the gamma squeeze. As the market continues to rally, we see certain technical milestones being hit, such as the 200 days moving average in the S&P 500. The moment the charts trade above that, the algos and the quant funds start buying the stock market and they start buying many other stocks. So now we have three forces buying the market. No wonder why we see such an impulsive rally. No wonder why bear market rallies have a notorious reputation of scoring 10, 15, even sometimes 20% worth of gains and shaking out the bearish sentiment and reviving a bullish sentiment back into the market. Stage number 4, when the hype becomes mainstream, the bear market is over, the bull market is here, look at the gains, bro, the retail mom and pops stampede. And now we got 4 forces buying the stock market together. But when we look at the reversal of the bear market rally, something changed in the sentiment, be it the false assumption in this case that inflation is dead, be it the false assumption that the Fed has done enough in raising interest rates, be it a shakeout in sentiment because a meme stock blew up, be it whatever reason it is. We see a reversal in sentiment and we start to see shorts selling again, shorting stocks again, and they combine that by buying a lot of put options. And as we see stocks reversing and the market maker looks at their positioning and they find out that they're overweight with these stocks because they've been buying them to hedge against call options buying. Well, now they no longer need them anymore as stock prices start to go down. So they start to dump too. And then the charts start to violate technical indicators, and that triggers algos and quant funds to start selling too. And of course, the last to come to the party is the last to get out. And usually they get out holding the bag. We see retail saying, okay, this is not a bull market, I'm going to lose money, let me get out. And now we have 4 forces dumping the market together, and we see the end of the bear market rally. So you got to keep your eyes on all of these elements. Are we seeing them or not? Is it different this time around? What would make it different this time around? All of these questions must be asked. But with this background out of the way, I'm going to show you a lot of indicators regarding sentiment and what's going on. And you tell me, are we seeing an exit stage in a bear market rally? Or is it different this time around? Are we seeing the reversal of a bear market rally? Or is this just a pullback? I'll show you the indicators. Let's have a discussion about it. But folks, before we start, if you've been watching this channel and you're not a subscriber, please do subscribe to the channel. We've been experiencing explosive growth in this channel. If we keep up, we might actually beat the number of mass shootings in America this year. Anyways, let's dive right into it. And here it is. In focus tonight. dumb money, or is it different this time around? You know, a lot of folks have been floating this in social media, the stages of a stock market bubble. When the bubble pops, we have a denial stage, which I would argue we've seen last year, as many analysts and experts, quote unquote, been coming out on TV saying buy the dip, buy the dip, buy the dip, inflation is going to cool down, the Fed is going to pivot, yada, yada, yada. They've been in denial. And late last year, they capitulated, of course, and they became bearish. Take, for example, Marco Kaplanovic from JP Morgan. But unfortunately for them, or maybe fortunately, who knows, this year their denial is equipped with perhaps more persuasive evidence. And this persuasive evidence is CPI inflation is actually cooling down, which makes the argument of, oh, the Fed is going to pivot and it is a great time to buy stocks more persuasive than last year. And now you're hearing all of these analysts who flip-flopped last year, flipping back into bullish mode and saying, no. The recession is not going to happen now because inflation is going down, the Fed is going to pivot. And oh, by the way, we're going to have a soft landing. The jobs market is hot. Everything is going to be fine. We're going to live happily ever after. And this is the return of the bull market. You're seeing it right in front of you. The bears, of course, would argue this is a trap. This is the psychological stage in any pop of any bubble called the return to normal. It fools everybody in. It gives them a persuasive argument that it's all clear. We're back to the bull market again. And then what do you know? Something, a new piece of data negates all of these arguments, all of these assumptions. What used to be a persuasive argument is no longer. We see the stock market moving down, proving that this rally was a bull trap. And we see the stage of fear that holy shit, this is real. The Fed up, inflation is not going down, we're seeing job losses, and job losses will accelerate because corporate earnings are not that good, and here comes the fear stage. This is, of course, what the bearish argument says. Until we find out who's right or wrong, there is no way to find out right now. We're going to find out 3-4 months from now. In the meantime, we have to look at this rally and what initiated the rally. Look at the quality of this rally. Does it really have the basics of a new bull market? Is it of high quality, something that we can believe in, or is the foundation of this rally flimsy to begin with? Well, here it is. Before the rally even began, we knew that the retail mom and pops were still in the denial stage, a lot of them at least, that yes, this is a bear market, you gotta step back. But at some point, the Fed will have to cut rates. At some point, the Fed will have to capitulate because fill in the blank reason. The debt is too high, they're gonna crash the economy, yada, yada, yada. And therefore, we have aggregate demand in the stock market, as we do in the housing market, as we do in the auto market, as we do in many corners of the economy. And that is evident, of course, by what we've seen so far. Mortgage rates went down immediately. Mortgage applications shot up higher. Tesla prices went down immediately. The aggregate demand kicked in, and we have a stampede on buying Teslas. In other words, the underlying conditions for inflation are not dead yet. When it comes to the stock market, it's the same. Stocks go down, and the retail crowd, mom and pops, perceive them as too cheap, but they're too afraid to buy first. They're waiting for somebody else to buy. They're waiting to see a little bit of a rally before they jump in. Once they do, that is effectively aggregate demand kicking in. In other words, financial conditions will loosen again, and most likely, inflation will also come back. This headline is from December 8th of last year. It reads, retail traders think stocks will bottom in 23, and they plan to load up on big tech, survey says. Only 1% of retail traders plan to sell off their investments in 23, while 65% will continue investing, and 29% plan to add to their portfolios. 80% of the retail mom and pops believe that the worst of the stock market rout will be over within 6 months. The majority, 72% of traders, plan to back individual stocks this year or next year, meaning 23, with 64% favoring big tech names, Apple, Microsoft, Google, and Meta. And you're going to see in a minute that they lived up to their end of the bargain. But what about the smart money? This is what we call the dumb money, the retail mom and pops. In a legitimate bottoming of the stock market and a start of a new bull market, we see a combination of retail and institutional buying. Let's see if we have this case or not. When we talk about dumb money, and again, whether you think the terminology dumb money is disparaging or not, that is beside the point. This is what they call retail mom and pops in the business, dumb money. We look at dumb money confidence. It is shooting up higher at 23, big time. The retail mom and pops are confident that this is indeed the start of a new bull market, and they're putting their money where their mouth is, and they're buying the stock market. The question is, what are they buying besides the big cap technology stocks? Oh yeah, the meme stocks, the most shorted stocks, the high beta names. Look, for example, at the ETF BUZZ, Buzz, which tracks the most shorted stocks aka meme stocks. It is outperforming the S&P 500 big time. So when we talk about the quality of the rally so far, is it of high quality or low quality? Now, any market bottoming, we see the most shorted stocks, the most beaten stocks experiencing a short squeeze because shorts are booking profits. Is this just retail mom and pops, monkey see, monkey do, following the pops in these stocks, or is it indicative that this is a low quality rally? And it's not a legitimate bottom, it's not a legitimate start of a new bull market. What do you think? Let me know in the comments. Look at the market volume this year. Retail orders as a percentage of all volume at the highest level in years, indicating a lot of the buying has been done by mom and pop investors. We have seen a stampede into one of the most favorite names by the mom and pops, Tesla. And by the way, this channel in late December refused to short Tesla, and instead we said we're going to go long because the stock is overbeaten, overshorted, it's time for a rebound. And indeed the rebound happened. And part of why the rebound happened is the stampede by retail mom and pop investors into buying the dip in Tesla. Matter of fact, retail buying of Tesla stock exceeded the level of buying that we've seen back in the stock split mania of 2020. But notice, they bought Tesla, not Apple. And maybe this is why Apple has been lagging the year-to-date rally so far. In other words, the retail mom and pops dumped their apples to fund buying the dip in Tesla. So far, so good. Tesla's up big time year to date, 55% or so. So again, I want you to ask the question and maybe answer it for me in the conversation below. Is this action in stampeding to buy the dip in Tesla indicative of a high quality rally or low quality? Is it high quality because Tesla was oversold and the fundamentals say that this is a buying opportunity, that Tesla became really, really cheap and retail mom and pops dumped their apples to buy the dip in Tesla? Or is it just a dumb rally? They looked at Tesla chart, it is way down, and they said, okay, Tesla been going higher, Elon Musk is smart, Tesla will be the future, bro, robo-taxis, yada, yada, yada. And they bought the stock. Which one is it? We covered Tesla earnings in details in this channel. Now remember, we talked about the stages of a bear market rally. It starts with short covering, some gamma squeeze, then the quant funds buying, then the retail mom and pops, and that is the most impulsive stage of the rally because it doesn't just come with retail mom and pops buying the dip in high quality stocks, but they also buy the shittiest stocks and they stampede in buying call options way out of the money, short expiration, looking to make a quick buck. Last week, call options volume shattered the record, the highest call options volume we have ever seen. Now again, is it really all mom and pops or is it something more sinister? Does it indicate a high quality rally underway or a low quality rally? Because if it is a high quality, why not have the conviction of buying the underlying stocks? Why use derivatives instead? And does such a spike in call options volume indicate a high quality rally or not? Well, the last time we've seen a spike in call options volume to this magnitude, it was back in 21 during the meme stock mania, the short squeeze in GameStop, AMC, etc., etc. Was that a high quality rally or not? Again, I'll leave the answers to you. You tell me. I'm not going to tell you anything right now. And when we talk about dumb money versus smart money, dumb money tends to chase individual stocks. Smart money uses huge inflows from pension funds, from retirement funds, and they usually buy ETFs. They usually buy indexes. When we look at the retail mom and pops, what did they buy so far this year? The answer is they delivered on their promise and they bought individual stocks. They're not interested in buying, the SPY, the Qs. They're interested in buying individual stocks, be it Nvidia, be it Tesla, be it Apple, doesn't matter. And the sheer size of buying these stocks pushed equities inflows to the highest level since November of last year. But if this volume was accompanied by institutional buying, we would have seen larger inflows. That is not the case. And again, the question becomes, are retail mom and pops ahead of the game versus the institutionals, a la 2020 in the aftermath of the crash of the thing? Retail mom and pops bought the dip, the institutionals were skeptical, and then they joined the rally. Or is it the usual bear market rallies and traps where the retail mom and pops jumps in, the institutionals stay on the sidelines, and then we see the rally reversing, and it becomes a selling opportunity, a profit-taking opportunity for the institutionals? Because right now, when we look at the QQQ flows, the NASDAQ, this is the ETF, we actually have record outflow, not inflow, in 23. In the month of January, $12 billion were sold in the triple Qs. In other words, somebody saw the pop as an opportunity to take some profits out. Yet when we see the flows for individual stocks, sky high. And this is the contrast between dumb money, quote unquote, and smart money. Matter of fact, BlackRock and Fidelity issued a warning last month that the market is underestimating inflation again. Now, is BlackRock buying? Fidelity buying? Maybe a little bit here and there. But are they betting that this is the bottom and the end of the bear market and the beginning of the new bull market? I haven't seen any indicators that that is the case from the institutionals. I have seen plenty of evidence that this is the case among retail mom and pops, but not among the institutionals, perhaps not yet. And it is certainly not the case among the insiders. Corporate insiders are dumping stocks like never before. Why would they be dumping? If this is indeed the end of the bear market and the beginning of the new bull market, they should be buying, not selling. And of course, back in 21, for example, when we covered corporate insiders dumping stocks, in this channel, we got mocked and ridiculed that, oh, that doesn't mean anything, you're just a perma bear. The market continues to go higher despite these folks selling their stocks, the insiders. What are you talking about? Fast forward a year later, and stocks crashed 70, 80, 90% in certain cases. And the insiders, the executives, walked away with a killing. Billions and billions of dollars. Are we seeing a repeat of this phenomenon again? I don't know. I'm just asking questions, folks. When we look at the dumb money versus smart money sentiment indicators, we see that the sentiment is sky high among dumb money, yet it is collapsing and making a new low among the smart money crowd. What's going on here? False indicator again? Or is it spot on indicator? And before you feel that the retail mom and pops are just dumb money and the institutionals are so smart, look at money managers. They pushed a lot of money year to date into the market. Not to the same magnitude as the retail mom and pops, but again, net inflows. They're buying the market. Now, as a former money manager myself, I would argue that money managers, at least some of them, are the embodiment of dumb money. They have no clue what they're doing and they follow the herd. When you call them and you ask, hey, did you buy the rally this year? Oh yeah. Why did you buy? You think valuations are good now? Not really. You think inflation is gone? Is it over? We don't know. Maybe. But it's going to take a long time. Okay. Do you think that the Fed will cut rates this year? No, absolutely not. But maybe they're going to pause earlier than we anticipated. So why are you buying the equities market right now? And the most common answer you're going to get is, well, other money managers are buying too. Again, we go back to monkey see, monkey do. And while the retail mom and pops are buying individual stocks, money managers actually chasing European stocks, developed markets, emerging markets, which I believe will end in disaster because as the dollar rebounds and move higher again, we will see weakness in these overseas markets, be it emerging markets or be it European equities. Now, when we look at other indicators to figure out whether this is a legit rally or not, we have to look at the correlation between equities and bonds. And we find out that this is the highest level of correlation since 1999. What happened back then? Whoops. And of course, when yields stopped, the stock market bottomed, quote unquote, at least for now. The problem is, as of late, in the aftermath of the hot, quote unquote, jobs employment data, yields are pushing higher. Be it the 10-year, be it the 2-year yield, all moving higher. And the assumption should be equities should pull back at least until we get further clarity from Jerome Powell and the Fed. But equities continue to fight. They continue to be stubborn, holding, waiting. And the question becomes, if yields continue to move higher, if the dollar is moving higher, if gold gave up the rally, if energy went down, we have plenty of indicators saying maybe the year-to-date rally is a fugazi. Maybe it's just another bear market rally because with the possibility of any revival and rebound in inflation, that comes with higher interest rates by the Fed, a more aggressive tightening. Therefore, the dollar moving higher, yields moving higher, but equities did not get the memo yet. And the question becomes, will equities be proven right? We hear the chairman of the Fed tomorrow coming out and saying, yeah, the hot jobs report doesn't mean anything at all. And even if he says that, will the next CPI reading confirm what he said or not? Or will it be bond yields, the dollar, gold, energy be proven right and equities wrong when we hear the chairman of the Fed coming out tomorrow and backtracking and backpedaling the mess that he did last Wednesday? Here's another indicator for you. We talk about the CNN Fear and Greed Index, which honestly doesn't mean anything to me at all. But when we look at the correlation between the peaks and the valleys in the reading of this particular index and the subsequent movement in the S&P 500, we see that when the indicator reads greed as it is reading right now, usually we're getting closer and closer for a pullback at least. When we look at the daily sentiment indicator, the DSI, every time we see a spike, just keep in mind that right now the DSI is in a bear market reading. It is below 60. But every time we see a shoot up higher, an optimism that we're about to get out of the bear market territory, back into bull market, what happens? We see a reversal and the sentiment sours again. The equities market subsequently moves down. The question becomes, we have at least done this twice in this bear market so far. Is third time a charm or not? And I know what you're going to say. Hey, Maverick, why don't you just tell us? And my rebuttal to that is, if I know, I wouldn't be doing this show at all. I'd be hiding in a bunker, being busy becoming the richest man on the planet. I'm just showing you all of these indicators, combine them all together, all the data, all the indicators, and you make up your own mind. I think you know where I stand if you've been watching this channel for a while. Here's another one for you. We'll look at the spread between the BBB rated corporate bonds versus the 90-day bill yield. Well, the reading that we have right now matches February 07, October 79, July 73, January 66, and May 29, 1929 that is. Are we in good company or not? You tell me. Here's another one for you. When we look at the Hubbard Nasdaq Sentiment Index, which has been accurate so far in this bear market at least, the reading is, shall we say, extreme for now. And usually when we've seen such extreme readings, that was accompanied by a pullback when the Nasdaq was in a bull market, and it was accompanied by the end of a bear market rally when the Nasdaq turned bearish in 22. So again, will history repeat itself, or is it different this time around? And if it is different, why is it? Let us know in the comments. We'll look at the sentiment among stock market timers. It is becoming exceedingly bullish. When it comes to Nasdaq-focused market timers, it is becoming more bullish than any other time since the year 2000. I wonder what happened back then. When it comes to gold timers, it's also got into the optimism zone. When it comes to bond timers, also in optimism, getting a little bit exaggerated here. So look at this and you tell me. I don't know nothing at all. I'm just reading stuff for you. God forbid I sound like a perma bear. And Gunjan, who happens to have the worst job ever, she has to spend her day talking to traders who trade meme stocks and, pretend that she's interested. But anyways, she says a soft landing is already priced in the U.S. equities market. Cyclical industrials have outperformed defensives by 12 percentage point year to date, reflecting a sharp improvement in the market's pricing of economic growth. And this is according to Goldman Sachs. Again, we have already priced in the soft landing. Any dent to this argument, anything that illustrates the soft landing is not going to happen, and you will see a reckoning. And folks, I end with this, and I keep reminding you, if you're betting that this is the end of the bear market and the beginning of a new bull market, you gotta be convinced with one thing, only one thing, the most important thing, that corporate earnings will improve from this point on. Now, here's what I want you to think about. Who creates corporate earnings? Where do corporate earnings stem from? The answer is the consumer. Consumer purchasing power. Consumer doing pretty good, they're buying more shit, and that equals more earnings to these corporations. Well, we now know that 57% of Americans cannot afford a $1,000 emergency expense. We also know that with this inflation, Americans are paying more for groceries, utility bills, at the gas pump, and most importantly, and perhaps the most devastating expense because you're in a contract, and the contract lasts for a year, minimum, rents. The average share of monthly household income going to rents in the United States is the highest this century ever, at 30%. To stimulate the economy, to improve corporate margins, to improve corporate earnings, we need the consumer spending power and disposable income to be healthy. Well, if they're spending 30% of their incomes on rents and the other 30 on eggs and the other 40 on OnlyFans, how are they going to stimulate the economy? But hey, folks, you don't have to listen to me. I'm just a perma bear, I'm a doomer, gloomer, whatever. And I remember when they said, beware of short sellers and perma bears, warning of bubbles. And this was back in January 29th, 2020. Whoops. Enough said. Anyhow, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 34.99 points, or a decline of 0.10%. The Nasdaq leading the pack to the downside this time around, down by 119.5 points, or a decline of 1% even. The S&P 500 down by 25.40 points, or a decline of 0.61%. When we look at the sector's performances today, number one capturing the gold, the silver, and the bronze metals, utilities, the only sector closing in the green. The ultra-defensive is now making a comeback. Is this a telltale for what's about to come? The rotation out of risk on, the year-to-date winners, all the way back to the year-to-date losers, aka last year's winners? I think it will happen. Just a matter of time. Because the laggards today, led by technology, communication services, and materials. When we look at the advance to decline ratios, NYSE 22% advancing versus 77% declining. The Nasdaq, on the other hand, 32% advancing versus 66% declining. Now, when we see such suppressed ratios to the downside, it usually indicates that we might see a rebound in the morning, and then we take it from there. So I'm not going to be surprised if I see the indices rebounding in the morning, and then Jerome Powell takes us to the woodshed so he can clean up his mess. On to commodities, and we're looking at energy here, despite the pop in the dollar. And this is really important. We've been talking about the catalysts and the tailwinds for energy, be it oil or natural gas. Now, natural gas got massacred, but oil has been resilient. And today displayed, let's say, relative outperformance. Because with the dollar shooting up higher, you would assume that energy should be down big. Instead, crude oil was up about 1.5% apiece for Brent and WTI. Natural gas was up actually by about 3%. Gasoline RBOB up by almost 3%. And perhaps the tailwind was the news that we got from Saudi Arabia that Aramco raised prices, surprisingly they say, and unexpectedly for Asian and US consumers. Now, of course, we talked about the Saudi oil minister in last night's video. They don't want to see oil below $80 a barrel. On the other hand, you have the Biden administration. They want to see oil below $70 a barrel so they can refill the SPR. So we have a conflict here coming, folks. It's going to heat up. And we know who has the upper hand in this fight. It's OPEC Plus and the Saudis. That is a massive tailwind for oil prices to move higher because the Biden administration ran out of ammo. They can no longer deplete the SPR. It's already depleted. Now we're going to talk about the refill. Now what about metals? With the dollar shooting up higher, metals were down all in all, flattish, but the reaction was muted. Yet keep in mind, gold was taken behind the woodshed on Friday and got shot twice in the head. So I'm not surprised to see a muted reaction today. However, if the dollar continues to move higher based on the commentary by Powell, I believe gold and metals will go down even more, specifically copper. So if you want to short copper here, maybe it's the time. Copper has been a winner year to date. Maybe it is a time for a pullback. Of course, the catalyst for copper, besides the dollar going down, the tailwind was, the other one, China reopening. Now with the balloon affair, we got a problem with China. Could that be a negative catalyst for copper prices to go down again? I think at least a pullback. And therefore, I'm hedging my position in Freeport McMoran. Bought some puts today. Now, when we talk about meats, I've been watching Tyson stock. For one thing, I own the stock. I bought it recently. And of course, they bombed earnings big time. And the reason is beef pricing. They lost the pricing power in beef. So I was watching beef futures in the morning, and they were up by about 1% or so. So we have a recovery underway in beef commodities. And I was watching Tyson stock. Are we going to see dip buying or not? The answer is not really. But it will be interesting to see if Tyson stock will recover or not if we continue to see beef futures moving higher. So I'm going to keep an eye on beef here. On to the big casino, the options market. What do we see here? The volume moved higher all in all, but we're seeing the put-to-call ratio improving a little bit, meaning we're seeing more buying of puts, although all in all, the buying of calls outweighing the buying of puts. But maybe a sign of caution here. Maybe market participants are saying, okay, maybe it's time to hedge before the 180 by Powell, perhaps. In any case, number one, the hottest table is Tesla, the souffle, with around 1.2 million contracts traded today. About 61% of those were calls. And of course, they're buying the 200 calls, they're stampeding in an attempt to initiate a gamma squeeze. The problem is, the stock is up 55% plus year to date. The market maker's positioning is already oversaturated with Tesla shares, so it's going to take a huge volume to initiate the gamma squeeze. And therefore, I say the risk on Tesla is to the downside. Apple at number 2 with around 900,000 contracts traded today. About 52% of those were calls. Now look at this. At number 3, AMC. And number 4, Bed Bath & Beyond. All with around about 900,000 contracts. In the case of AMC, believe it or not, folks were buying puts, not calls. They were fading the rip with about 56% of the volume buying puts, not calls. In the case of Bed Bath & Beyond, they were buying calls, obviously. 65% of the volume was calls. The problem is, look at the IV rank. The implied volatility is really, really high, meaning it's going to take the stock to double for you to make money on these calls because you're paying an insane premium. Likewise, if you're betting against Bed Bath & Beyond, you need the stock to go down by 60-70% for you to flip any puts into profit. And therefore, folks, when you look at the IV rank and it's at 100%, the opportunity is gone. You want to ride the wave when the implied volatility is low. So you can ride the wave of premium appreciation, whether you're buying calls or puts, as the implied volatility increases. On to the unusual activities that took place in the casino today. We begin with the Russell 2000 the IWM small caps. Somebody's fading the rip here, and they bought the 181 puts for the expiration date February 24th, with expectations that the IWM could move down and lose more than 6.5% of its value by then. They paid around 60 cents a piece to enter this trade, all in all spending around $600,000. And then what about the ticker GLD? This is the gold ETF. Somebody's betting on a rebound here, maybe a little too early, but anyways, they bought the 195 calls for the expiration date April 21st, with expectations that GLD will move higher and gain more than 12% by the expiration date. They paid around 45 cents a piece to enter this trade, all in all spending around $450,000. And then what about the trade for the ticker MRO? This is Marathon Oil. This is not the stock that I own. The one I own is Marathon Petroleum, MPC. I know a lot of you say, hey Maverick, I followed you and I bought Marathon, and then I find out that you bought MRO. I'm not saying it's good or bad. I'm just saying it's a different company than Marathon Petroleum, MPC, the one that I own. Anyways, the trade for MRO, Marathon Oil, somebody sees more upside coming here, and they bought the 29 call for the expiration date April 21st, with expectations that MRO could advance higher and gain more than 12.5% by the expiration date. They paid around 80 cents a piece to enter this trade, all in all spending around $500,000. And then what about the trade for the ticker GOOGL? Google, a company that we love and adore, but somebody sees it going down, and they bought the 96 puts for the expiration date February 24th, with expectations that the name could move down and lose more than 6.5% of its value by then. They paid around 70 cents a piece to enter this trade, all in all spending around $350,000. Last but not least, at the bottom of the table, what about the ticker FNV? This is for a gold trader company called Franco-Nevada. Now, this is not a gold miner. This is a gold royalty company based on Canada. I'm not saying it's a good buy or not if you want to trade gold, but just keep in mind this is not a gold miner. Anyways, somebody sees massive upside coming for FNV. They bought the 160 calls for the expiration date April 21st, with expectations that the name could move higher and gain more than 17% by then. They paid around $1.40 a piece to enter this trade, all in all spending around $600,000. On to the heat map analysis. What do we see here? Now, I've been talking for a while now that at some point when this insanity stops, we're gonna see a rotation into last year's winners, this year's losers, and a rotation out of this year's winners, last year's losers. Are we seeing this rotation happening right now? Was today the beginning of this rotation? Look at the winners today. Some names in Big Pharma, Merck, for example, Gilead moved higher, although Johnson & Johnson, Pfizer remain lagging. The defense contractors popped higher, LMT, Northrop, Raytheon on World War III optimism. Utilities popped higher, even though yields moved higher. That's interesting. We'll look at the consumer defensives, the food companies, PepsiCo, Coca-Cola, Mondelez, General Mills, Smucker, all losers year to date, but they caught a bid today. And I would argue this is the buying opportunity. Don't come to me 3 months from now crying and say, hey, Maverick, you missed out, you didn't tell us. I'm telling you right now, the opportunity is in these names. I don't see the opportunity in declining earnings in the mega caps or the semiconductors or the software cohort. These names got dumped today, along with the year-to-date winners in communication services and cyclicals, meaning the reopening names, the cruises, the airlines, the hotels, the casinos, all got dumped today. Chinese names down too. And the question really becomes, will Jerome Powell reinstate the risk-on rally and we see a rotation of today's action, or will he confirm today's action by saying, hey folks, I messed up in the last meeting, I did not have enough sleep, I did not think through, whatever. And in reality, we don't have a disinflation process, and we have a risk that inflation could actually be revived. Now, is he going to say that? Of course not. But he might sound or attempt to sound a little more hawkish than last Wednesday. And I say most importantly, forget about what Powell says. Look at the reaction of the dollar and yields. If they move higher, as Powell moves his haul and speaks, the market is saying rates will go higher, and you got to stick with this rotation that we did today, moving out of year-to-date winners back into year-to-date losers. Now, here's a quick update for you in the tsunami of layoffs. We have bad news today from Dell, slashing 6,000 jobs. But the Fugazi employment report from Friday says we created over 500,000 jobs in the month of January. And of course, the delusional Secretary of Treasury, Janet Yellen, she says, oh, there is no risk of recession when the economy is creating 500,000 jobs. Same lady who said that inflation is transitory. Keep that in mind. And since we're talking about monkeys, what about AMC? We talked about the recession part with Dell slashing 6,000 jobs. Let's talk about the inflation part of stagflation. AMC AT&T today announced that they're going to charge more for the premium seats. These are the middle seats, the most demanded seats in the blockbuster releases, Avatar 2, whatever crap Marvel you watch. You're going to pay more. When we look at the heat map for the ETFs, last night I said that the dollar is moving higher. Or we're seeing an appropriate reaction by certain ETFs. If the dollar is moving higher, oil ETFs should be down. Gold ETFs should be down. Likewise, international, but specifically Chinese ETFs should be down. If yields are moving higher, real estate ETFs should be down. And they were all down. The only exception is when yields move higher, when the dollar moves higher, we should see chips and technology moving down. Yet chips and technology were moving higher. And I said, is there a lag? And is the opportunity betting on this lag, meaning shorting chips, SMH, shorting the XLK technology? What do you know today? We have an appropriate reaction. The dollar is higher, XLK down, SMH down, so is gold, GDX down, XOP energy down, materials, XME down, IYR, real estate down. So we're seeing now an appropriate reaction even in international markets, Chinese ETFs down big. The question becomes all of that money that is coming from all of these ETFs because the dollar is rebounding, because yields are rebounding, where will that money go? Well, maybe we have an answer today because natural gas popped higher. Look at UNG, BOIL, big time. Are they buying the dip in natural gas now? I gotta see it to believe it. I gotta see natural gas rallying for at least 3 days in a row, and then I'm gonna believe it. But is the money moving back into the defensives, XLU, utilities, consumer staples, XLP, healthcare, XLV? Maybe. Today we got the XLU moving higher. XLP by a tiny bit. We need to see more to confirm that we have a rotation here. In the meantime, moving on to charts, and what do we see here? We start with SPY, 30 minutes chart. We have a gap down and then consolidation. Low volume, consolidation of the support, 410 for the SPY. Now, the bullish way you can read this is we're taking some air out of the bubble. We have a gap down, letting things cool down a little bit, testing the support of 410 back and forth. But then we see the energy coming back into the market after the excess is flushed out. And we see a rebound and the SPY goes all the way back to 416. Now, the bearish way you can look at it is a gap down and a formation of a bear flag pattern, indicating the next step is going down to 405 and erasing the entirety of the FOMC rally. My 2 cents say that the truth is between. I think we go higher in the morning to close the gap, and then Jay Powell opens his mouth, and down we go, breaching the support of 410 all the way down to 405. What about the daily chart for the continuous contract for the S&P? Nothing happened today. It went down at a retest to 4,100, which is an important support line, and it rebounded by a little bit. We'll look at the volume, it moved down. We'll look at the momentum indicators. The RSI remains in positive divergence. The MACD remains showing positive momentum. And for all you know, this could be a formation of an ABC pattern. And therefore, I say for the bears, always be closing until you get the confirmation. When you buy these puts and you have big flush downs, pullbacks, take some money out, book some profits, because so long as the narrative remains intact, what narrative are you talking about, Maverick? I'm talking about the soft landing narrative that we have inflation cooling down and the Fed backing off and corporate earnings recovering. If we get any indicator that inflation is about to come back, for now we have to wait for the CPI, so that's not going to be it. But could it be that the Fed is not going to back off? Maybe tomorrow Powell is going to confirm that. If he does, then one important corner in the foundation of this rally will be demolished. Then you get your confirmation. Then you can double down big. But absent of that, you got to be careful not to be caught in an ABC pattern. Likewise, when it comes to the Qs, the same exact discussion with SPY. Maybe a little higher in the morning, and then we pull back. At the end of the day, we need to go back all the way to 300, retest that support. But in all likelihood, if we go down there, it's not going to hold. Or we go down all the way to 294.33, erasing the entirety of the post-FOMC rally. And again, when we look at the daily chart for the continuous contract for the NASDAQ, maybe if you want to hold these shorts, you gotta book profits quickly. Maybe we close the gap below, and then we see an ABC that takes us higher all the way to the next resistance. That could be at around 13,000. Because the volume is down, the RSI is in positive divergence. The MACD indicator is in bullish momentum territory. All of these indicators could flip tomorrow. But until you get the confirmation, you gotta be cautious here. IWM 30 minutes chart for the Russell 2000. Maybe this is your leading indicator because the Russell was the laggard today. It moved down, lost 196.5 as support, and it pretty much closed at the lows of the day. Now, if the Russell goes down to 191.5, it erases the entirety of the post-FOMC rally. Maybe this is what's going to happen because look at the dollar. The dollar bounced higher. It erased the entirety of the post-FOMC losses. My assumption is the equities market should do the same. In other words, Tricky Dixie fooled all of us.
You fooled him, G. You fooled him. You fooled them all.
And now it's trading above 103, and it has plenty of momentum in the RSI and the MACD indicators to move higher if it wants to. If J. Powell gives the green light, saying, whoops, I messed up, I did not mean what I said last Wednesday, maybe rates should go higher by 50 basis points in the next meeting, then we got a problem here, and Dixie is going to move higher, and we have 106 as a number we should look for. And look at gold, massacre, almost erasing the entirety of the year-to-date rally. And some of you have been saying, hey, Maverick, sour grapes, you've been shitting on the rally because you missed it. And I said, you got a point. Of course I'm pissed off that I missed the rally, but I'm not a moron. I'm going to get a better opportunity. It's going to pull back. It's going to give me a better entry point. But some of you guys are seduced so fast. They dangle a little rally right in front of you and you jump right in. You're the same guys who go into a bar and here comes a hot chick. She starts flirting with you and you fall for it. And next thing you know, she's a Mossad agent and Israel has a sample of your testicles. Not me. I don't fall for that kind of crap. The first thing I'm asking is, why is she into me? What's the catch here? When gold rallies all of a sudden, when the stock market rallies by 20% year to date, I'm asking myself a question here. What is the catch? Why do we deserve this generosity all of a sudden?
Why do I deserve this generosity?
Anyways, what about Brent oil, a daily chart? It is rebounding from almost exactly where it's supposed to. It did breach the trend line, but it is keeping the most important number, 77, as support. Now, let's say the dollar continues to move higher. 104, 105, 106. Can energy and oil withstand the storm of the dollar moving higher? If it does, then folks, you gotta buy the dip. That is called relative strength. That is called a bull market behavior. And if we see that, you gotta buy the dip in oil because the tailwinds are numerous. But it's too early right now. Give it a little time. When we look at the 10-year yield, what do we see here? Double bottom, moving higher above 3.5. And now, of course, it's signed 4%. And if J. Powell comes out with the 180, it's gonna go to 4%. And in that case, TLT double top, it goes down 103.5. That is support number 1. Support number 2 would be at around 100, aka the support zone. VIX 4 hours chart. Do we have to pay attention to the VIX anymore? The VIX is irrelevant. We might see a nuclear war and the VIX will still be under 20. But for now, we have a rebound. We have a bull flag consolidation pattern. We have a positive divergence in the RSI. It should pop higher, but who knows? The VIX has been acting in mysterious ways as of late. What about Apple, the big kahuna? 30 minutes, what do we see here? We talked about the possibility that the bull flag is not going to play out, and Friday was an overreaction due to mechanical reasons. And in reality, Apple does not deserve to be traded above 150. This was the worst earnings report in 6 years. And now all of a sudden you want to buy Apple? Now all of a sudden Apple is worth above 150? When last year it got rejected over and over and over again, even on better earnings? When you compare it to the latest disastrous report? I don't think so. And what we could be seeing here is a formation of a head and shoulder, which will break the support of 150 and down we go back to 145, erasing the entirety of the post-FOMC gains. Tesla, we talked about the pattern on Discord. This is a 15 minutes chart. We have a consolidation pattern. Higher lows, lower highs. Now we got to break above or below the consolidation range for us to have a trade one way or the other. For now, the support/resistance remains 194.55. We don't have a break yet, but we might have one by tomorrow. And if I had to lay a bet, I would say it should be to the downside because the gamma squeezers who've been buying the 200 calls, they had ample opportunity to push this stock higher and they couldn't make it. And at some point, the buyers have to give up and say, okay, we're not going to make it to 200. Let's book some profits right now. Here comes the sellers and down we go. Bitcoin, tulips, what do we see here in the daily chart? It couldn't make it above the support, now resistance, which stands at 23,189. And it appears more likely than not that we're going to see the head and shoulder formation. Now let's talk about some Discord trades here. We begin with the earnings call that I floated in my last call before we got big tech earnings last Thursday. I said Amazon and Google calendar puts These are the 100 puts, which is, by the way, my favorite kind of trades. Calendar calls, calendar puts, doesn't matter. But in this case, what I did is buying the 100 puts for this Friday's expiration on both Amazon and Google, and then I sold last Friday's 100 puts on both. This is what we call a calendar put spread. You're buying 1 week ahead, you're selling the immediate expiration. Now guess what? Both Amazon and Google did not close last week below 100, which means the entire credit from selling the 100 puts with the expiration date of last Friday is now in my pocket. And that leaves the long leg of the trade, meaning the 100 puts that I bought for the expiration date of this Friday open. Now that leg on Amazon is worth about $1 a piece. So remember, bought the entire spread for 35 cents a piece. Now I'm sitting on gains worth $1 a piece, and that is a gain worth about 300%. I have expiration on Friday. I'm not a degenerate gambler, so I did book some profits today, and I left some house money to roll. But in all likelihood, I'm going to close the entire trade by tomorrow. Because for now, when we look at Amazon, we have support at 97. Now, if J. Powell comes out hawkish, we could see Amazon all the way down at 97 by tomorrow. And in that case, I close the trade with gains of almost 1,000%. But remember, you don't want to go crazy here. And the reason is we have expiration this Friday. If it was February 17th, if it was March expiration, I would have said, okay, you can roll the dice. I'll wait till Amazon goes down to 97, maybe 95, maybe it crashes all the way back to 90. But because I have expiration this Friday, I gotta book profits. Because what if this is an ABC pattern in the making? What if Amazon goes all the way down to 97, or even that's it? Today's pullback is it. And tomorrow, J. Powell screws up again, but we see Amazon rebounding, making higher highs in the C leg. You don't want to assume this risk. You don't want to screw up the trade. You're sitting on gains worth about 300%. You thank the Lord, you move on. Now, when it comes to Google, it's a similar case. Although the contract in the long leg is now worth about 60 something cents a piece, meaning I'm sitting on about 80% worth of gains. Now Google could go down and close the gap. That would be a decline of yet another 2.5% or so, and the leg will appreciate even more. But why take the risk? So I took some off the table today, and I'm letting some go all the way till tomorrow. But in all likelihood, once again, I'm going to close the entirety of the trade by tomorrow, because what if this is a formation of an ABC pattern? Now also today in Discord, I talked about some of the names that I'm eyeing: Tesla, Apple, Q's, RKK, Nvidia, Tyson, MicroTrageedy. Now in most of these names, we haven't seen a definitive sign to initiate a trade one way or the other. We have some indicators that the bet should be buying puts in these names such as RKK, Nvidia, but we don't have a definitive sign yet. Now, when it comes to Meta, a lot of you are talking about Meta. I'm looking at 183.85 as support. When we look at the weekly chart, it is a gravity point. The chart consolidates in or around this number back and forth, sometimes for months. So we know that this level is a magnet. Now we're already back at the magnet, and the chart is becoming overbought, overextended, at the risk of pulling back. If we zoom into a daily chart, if 183.85 is violated, we could see a move down. Now, I'm not going to say all the way to closing the gap, but we do have support at 155. Is it going to go all the way down to 155? I don't know. But if 183.85 lost the support, we have a pullback, and it could be a sizable one. For me, that would be a shorting signal. And last but not least, what about VLO Valero? I showed you the trend line, and I told you I'm going to buy and add to my position if we go down to the trend line. Now, here's a weekly chart for Valero VLO. We are almost at the trend line right now. We don't have a rebound yet. The chart made an ugly topping candle, so there is risk here, and therefore I have the 125 puts. I bought some and I sold some. Why did I do that? I bought some as a hedge, and I sold some because if we see a rebound from 125, aka the trend line, and the selling stops, yet Valero closes below 125 by the expiration date, then I will have the option to convert these put options and buy a position in VLO. For now, it is a trend of lower highs, although we had one higher high, and that is a false breakout. But the pattern of higher lows continues. So the odds say that we will break to the upside again. But the risk is if we see a break to the downside, making a lower low, then you gotta be careful. Maybe your hedging strategy should be buying some puts if you're already in the name, or have a stop loss. Let's say 125. If that is violated, you get out, you wait for a better opportunity, perhaps further clarity. And with that, folks, we move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have consumer credit. Most importantly, we have Jerome Powell speaking at the Economic Club of Washington. And obviously, all eyes will be on J. Powell. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Wallace said these were just rumors. right? So we have no reason to think that the company's anything but fine. So if we just go on with our work, you and me, they'll follow along.
Monkey see, monkey do.
That's it.
Monkey pee all over you.